Hello, my name is Leroy Meadows, and I want to welcome you to this session. In this session, we're going to work on exercise 21-22 from our cost accounting book dealing with capital budgeting methods. So let's go ahead and get started here. This is exercise 21-22 at the end of your chapter. So let's go ahead and read the problem here. Yummy Candy Company is considering purchasing a second chocolate dipping machine in order to expand their business. The information Yummy has accumulated regarding the new machine is the cost of the new machine is going to be $80,000. The increased annual contribution margin is $15,000. The life of the machine is going to be 10 years, and the required rate of return the company requires is 6%. Yummy estimates they will be able to produce more candy using the second machine and thus increase their annual contribution margin. They also estimate there will be a small disposal value of the machine, but the cost of removal will offset that value. Ignore income tax issues in your answers. Assume all cash flows occur at the end of the year except for initial investment amounts. And then we're asked to calculate the net present value, the payback period, discounted payback period, internal rate of return, and accrual accounting rate of return. And then we'll also talk about some additional factors that Yummy Candy should consider in deciding whether to purchase the new machine. So let's go ahead and get started with calculating the net present value. Now remember, the net present value is simply going to be taking into account the time value of money in determining whether this investment is going to be profitable or not. It does not tell us the actual rate of return being earned, but the net present value will let us know if we are at least earning our required rate of return, which is 6%. So now remember, the net present value is going to be stated in dollar terms. So we're not going to get a percent, we're going to get dollars, but a lot of times this is more valuable because it's going to allow us to estimate the impact of this investment on our income statement. If we do a pro forma income statement and we just want to see how it's going to impact everything in the future, this will allow us to do so because it's not going to be expressed in terms of a percent, but it's going to be expressed in terms of dollars. So let's go ahead and calculate the net present value. Now, in order to do that, we have to first determine the cost or the additional cash flows or the additional increase in operating income, increase in contribution margin, and how they are occurring. Are they occurring in the same amount each and every year? Or is it going to be a different amount each and every year? Because some cash flows, cash flows may vary by year, in which case we have to discount each cash flow back to the time zero. In this case, the cash flow, the increase in annual contribution margin, is going to be the same each and every year. Now, so we can use the present value factor of an annuity. Why? Because remember, the annuity is the same dollar amount in equal intervals. Doesn't say how often those intervals have got to be, as long as they're on equal intervals. So equal cash flow, $15,000 each and every year, it's not changing, and equal intervals. So that's all that matters here. So I can take, in order to calculate the net present value, the first thing I have to do is take my $15,000, my annuity, the amount of the payment each and every year is the same, and multiply that by the present value of an annuity based on 6% for 10 years. So what am I going to do? I am going to go to my annuity factor table, and this is in the appendix to the book, not to the chapter, but the appendix to the book. And I'm going to look at the annuity factor here, and this is going to be table 4, and we can identify this as present value of an annuity of $1. So the annuity part is just stating that they're equal payments and equal intervals. So that's how I know which table to go to, because this is an annuity. So let me go ahead here, and we're going to look at 6% for 10 years. And when I do that, I come down here to 6%. I go down, and then I go down to 10 periods. I see where they intersect, and my annuity factor is 7.36. So I'm going to take my $15,000. Oops, let me go back here and let me get my calculator out. So I'm going to get my $15,000 times the annuity factor of what, 7.36, and that's going to give me the present value of all my future cash flows. Now from that, I need to subtract out my initial investment of $80,000. And when I do that, I see that I'm going to get a net present value of $30,400. Again, this is the quick and easy way to do it because the cash flow is the same dollar amount in equal intervals. If it wasn't, then I'd have to discount each cash flow from the first year to the 10th year individually using the present value of a single dollar table. So my present value of the net present value is $30,400. And what we're going to do here. Now, if I want to do it in Excel, I can do it pretty quickly in Excel. What I'm going to do is I'm going to create my formula equals NPV parentheses, and then see the tooltips down here at the bottom, and it's going to tell you what you're looking for first. And the first thing we want to know is the rate. Now I can either type in 0.06, or I can have my table over here and click on the cell for 6% for my required rate of return, comma, and then I'm going to highlight these cash flows, the increase in contribution margin from year 1 to year 10, close my parentheses, and then add in my initial outflow, which is minus 80,000. Why do I have parentheses against for my cost of machine or my outflow? Because remember, when we talk about cash flows, a positive number means cash coming in. Amount in parentheses means cash going out. So I want to add in my cash going out of minus 80,000, and that gives me rounded $30,401. So I know I did the net present value correctly when I went through the table. Now, why do we have this here being $1 off? Well, it's simply because of rounding. When we go to the tables here, we see that most of these numbers are gone out to the 3 points past the decimal point. In reality, these numbers will go out, can go out 4, 5, 8 numbers out, maybe more for some of these figures. So these are rounded, truncated numbers. So these are rounded to the third number to the right of the decimal. So they're rounded out to the thousandth position. So that's why we're going to have a little bit of a discrepancy when taking rounded numbers versus calculating the net present value. Is going to actually take the full number and multiply it, the full annuity factor, and multiply it by the cash flows, and then taking out the cost of the machine. Okay. So now, what about the payback period? That's part B. We need to calculate the payback period. Well, the payback period, we simply have to look at those cash flows again. And in this case, because the cash flow is the same, what I can do is just take my initial investment, the cost of the machine, $80,000, and divide that by $15,000. And that will tell me how many years it will take me to get my investment back. Divide by 15,000. So my payback period is going to be 5.34 years, or 5.33 years actually. Now, no, that's not a percent. So what is this telling me? It's telling me here the payback period 5.33. It's going to take me 5 1/3 years to get the cash back. Now, it's not earning me a rate of return or anything like that. It's just telling me that this is how long it's going to take just to get my $80,000 back. This is not taking into account inflation. This is not taking into account the required rate of return. It's not taking anything into account other than how fast do I get my initial investment back. And remember, over the payback period, one of the weaknesses is the time value of money. It does not incorporate the time value of money. And the other major weakness is that it ignores cash flows past the payback period. So after 5.33 years, it doesn't matter to me because all I care about is that point in time when I get my cash back from my initial investment. Now, I can offset one of the two weaknesses, and that's taking into account the time value of money with the payback period. What we're going to do is take the payback period, discount each one back to the present value, and then we'll figure out a payback period from there. So now in order to take the payback period, the discounted payback period, we are going to have to discount each and every cash flow back to the present value, or to period 0, time 0. And then we will compute how long it's going to take us to get back our unrecovered investment. So since we're discounting each and every cash flow back to the present, we do not want to use the annuity factor here. Why do we not want to use the annuity factor? Because we're only considering certain amount of cash flows. We're only looking at seeing at what point in time, after taking into account the time value of money, do we recover our initial investment. So for the discounted payback period, we are going to have to discount each cash flow back individually. So we're not going to be able to use the annuity factor here in this situation when using the discounted payback period. So what I'm going to do is, I know that my investment is 6%, and my required rate of return, the life of the machine, is 10 years. So what I'm going to do is go back to my appendix. But since we are not using the annuity factor, because we're going to discount each cash flow individually, I'm going to go to table 2 where it says the present value of $1. And then I'm going to look at cash flow 1, $15,000, and multiply it by the 0.943 to get me my discounted, take into account the time value of money for year 1. So I'm going to take my 15,000, discount it back by the factor of 0.943, and then so that gives me a discounted cash savings of $14,145. And again, this is the taking into account, we're just looking at cash and discounting it back to the future. So So after year 1, my cumulative discounted cash savings is $14,145. And so my unrecovered investment at the end of year 1 is going to be $65,855. So now let's look at year 2. Year 2, $15,000. Now I'm going to look at my 6%, and I'm going to discount that back 2 years because I want to discount it back to the present value. So I want the present value as in terms of today. So since I'm 2 years out, I want to discount it back 2 periods. So I'm going to go to my present value table of $1 and find my 6%. And then I'm going to go ahead and take that $15,000 cash flow in year 2 and multiply it by the discount factor for period 2, which is 0.890. So now I will multiply this by 0.890, and that will give me a discounted cash savings of $13,350. So what's my cumulative discounted cash savings, or my cumulative discounted cash coming in towards my unrecovered investment? Well, the cumulative amount so far is $27,495. Oops. So the amount I have left to recover is, I put the wrong sign in here. And I'm going to unlock this cell so I make sure I can use that formula again. It's $52,505. And that's the amount I have left to recover after year 2, when I take these cash flows and discount them back and take into account the time value of money. So now in period 3, in year 3, I'm going to look at the cash flow factor from there, and that's what? 0.840. So I'm going to look at 0.840. And then, so the discounted cash savings in year 3, 12,600. So what is my cumulative amount of cash savings? $40,095. So out of my initial investment by the end of year 3, taking into account the time value of money, I've recovered half, just over half of my investment. And so how much left do I have to recover? $39,905. And then we'll go ahead and go to year 4. In year 4, my factor is what? 0.792. I will look on the table under 6%. Period 4, 0.792. And then I would do the same thing for each and every year. And at the end of year 5, I still have to recover of my initial investment $28,025. So let's go to year 5. That was in the year 4 actually. Let's see, year 5. What's my discount factor? 0.747. And so there, at the end of year 5, I have yet to recover $16,820. Now, so let's go to year 6. Once this gets small enough, and see, I haven't recovered it yet, I want to keep going until I figure out between which 2 years I'm going to recover. What year am I going to recover my initial investment here? So year 6, I'm going to take the discount factor and multiply it by $15,000, my cash flow. That's 0.705. So, and that gives me $10,575,000. So, through year 6, I recovered $73,755 of my initial $80,000 investment. So how much yet do I have to recover? $6,245. Now, what I'm going to do here, so I'm going to go ahead to year 7, and I'm going to figure out my discount factor for year 7. And if I go back to this table here under 6%, for year 7, 0.665. So let's take my discount factor, it's 0.665, multiply it by 15,000. This is my discounted cash savings. Now, how much left do I have to recover at this point? Well, I've recovered everything, so I don't have to recover anymore. So, what I'm going to do, so I know that my recovery is going to occur in the 7th year, not after 7 years, but in the 7th year. And how do I know that? Because I've now had my cumulative discounted cash savings is now more than my unrecovered investment. Once this occurs and my cumulative discounted cash savings is greater than my investment, than my unrecovered investment, then I know that some point between year 6 here in this case and year 7, I've recovered my investment. But how long is it going to take? Well, it's going to take me how long? Well, I'm going to take the figure. I know it's going to be 6 years. So let's take, and it's going to be 6, and then how many parts of a year? How far into the year? Well, I'm going to take my $6,245,000 of unrecovered investment in year 6 and divide that by the amount I've recovered in year 7 of $9,975. So I'm going to take my 6245 and divide that by my 9975. And so it's taking me 0.63 years. So add to that. So about almost 2/3 of the way through year 7, I'm going to recover that. So 0.63. So it's going to take me what? 6.63 years to recover my just to recover my investment once I'm taking into account the time value of money. So that is my discounted payback period. Now, let's take a look at the internal rate of return. Now, when calculating the internal rate of return, I can manually do this and calculate the internal rate of return as long as I've got the annuity factor going here. And remember, we did because each cash flow was the same. So what I'm going to do to find the annuity factor of my internal rate of return, I'm going to take my $80,000 and divide that by the amount of my annual cash flow. So I'm going to take my investment, divide that by my annual cash flow, and I get 5.33. And this is, again, over a 10-year period of that this rate of return is occurring. So, or the life of this project, rather. So now I'm going to go to my annuity factor table, the present value of my annuity factor table. So let's go to I want this here. And my actual rate of return is going to be what? I'm looking at it for 10 years. And I'm going to look to see if I can find that 5.33 anywhere. And I'm going to go across under period 10. I'm going to go work my way horizontally across until I see 5.33. Well, I don't see 5.33 in here, but I do see that 5.33 would fall somewhere between 12 and 14%. So I know that my internal rate of return, the actual rate of return I'm earning on this project, is going to be somewhere between 12 and 14%. Now, I could just stop there and say, hey, this is higher than my required rate of return, so I'm happy, but I want to know, what am I actually getting? So one thing I want to note is the percent difference between where this falls in between. It falls in between 12 and 14%. So I've got a 2% difference there that this could be anywhere from 12 to 14%. I know it's not exactly 12 and it's not exactly 14, but with these columns being 2% apart, I want to take that into consideration. I'm going to need that here in just a moment. So what is the present value of 10 periods at 12%? 5.650. So I want to note that here. So I'm going to take that into account here. And I'm going to 5.650. I'm going to put it over here too. And you'll see why here in just a moment. Now my internal rate of return, I know that I just calculated is 5.33%. So now let's go and figure out the discount factor or the annuity factor of 14% at over 10 years. And that's 5.216%. So I'm going to go ahead and put that over here. Now I'm going to figure out the difference between these two. What's the difference between my annuity factor? What's going to be the numerical difference between 12 and 14%? Well, it's going to be 0.434%. So that's the difference between the two. Now I want to take the difference between my internal rate of return, which is my annuity factor for my actual percent, which is 5.33, and I want to take the difference of that and the lower one, which is 5.65. So, or the lower percent, which in this case was 12%. So I know it's going to be above 12%. I'm not sure how far. So I'm going to take my difference between my 5.65 and my 5.333. And that gives me 0.317. Now I can take my 12%, and here's how I'm going to do this. I'm going to type it out for you, and then I'm actually going to calculate it on my calculator, and then we'll figure out what the internal rate of return is. So now I'm going to take my 12%, add to that my 0.317 divided by my 0.434, and then I'm going to multiply it times that 2, because there's a 2% percentage difference between 12 and 14%. And so when I multiply it by 2%, I'm going to get, oops, and when I do that, and when I multiply that out, I'm going to get 13.46%. and that's going to be my internal rate of return, and that's the interpolation method. Now, I can do this a lot faster. In fact, I want to do it with Excel. In fact, that's going to be the only way I can do it is with Excel or a business calculator, if I have different amounts for each year. What can I do with Excel? Well, I'll take my formula and equals IRR for internal rate of return, put parentheses, and then I'm going to go up here and highlight my cash flows, beginning with the cost of the machine, my initial cash outflow, all the way up to my last year of additional cash inflow, or throughout the whole life of the project. And then I'm just going to close the quote here. And that tells me that 13%, let's pull this out a little bit, and 13.43%. So my actual rate of return is 13.43%. We got 13.46% up here. Again, why was that difference? Because these annuity factors are truncated. So that's why it's going to be a little bit of a difference because of rounding issues. But that's how we would interpolate the internal rate of return. But I can also do this through Excel. Now, if you are required to do the interpolation method for whatever reason, then you would need to go with this amount when you're entering your answer. If you just ask for the internal rate of return in general, and you have to do it through Excel, then you would just go ahead and do it through here. So, and then part E, we have to account for the accrual accounting rate of return based on the net investment method. Remember, the book actually illustrates two methods, and it also points out that different companies may have different methods of doing this. So we're only going to look at the net initial investment method here. So what's my net initial investment? Whoops, wrong one there. My net initial investment is what, $80,000. What's my estimated useful life? Well, we're told in the problem is 10 years. So what's my annual straight line depreciation? Well, assuming straight line, I'm going to have annual depreciation of $8,000. So using the net initial investment, I want to take my annual increase in cash flow, my increase in expected average annual operating income, so annual on a yearly basis, my average, subtract out my depreciation, because remember the cash flow is including the depreciation, so I'm going to subtract out my depreciation. So I'm going to take out my $15,000, subtract out my depreciation, and then divide that by my initial investment. Oops. And of course it's wrong because I put a comma in here. There you go. And now my accrual accounting rate of return is 0.0875. Let me format that to be a percent and then move that over. And I see my accrual accounting rate of return is 8.75%. So now I know my accrual accounting rate of return. Now note how the accrual accounting rate of return differs from my internal rate of return. And why is that? Because this is two reasons why this is based on accrual accounting and internal rate of return is based on cash flows. The second difference is the accrual accounting rate of return does not incorporate the time value of money, whereas the internal rate of return does. So that's the difference here between the two. But that's why we're going to see marked difference or differences between the accrual accounting rate of return and the internal rate of return. Now, the payback period, accrual accounting rate of return, these are good for screening in our investments to see should we go any further and expend any more effort or energy into analyzing an investment. Our company is going to give us a minimum or a maximum payback period. All investments have to be paid back in 3 years, 4 years, 2 years, whatever it is, and we're going to have to meet an accounting rate of return requirement. So as long as our payback period falls less than what the maximum our company has set, or the accrual accounting rate of the accrual accounting rate of return is more than our required rate of return, which in this problem was 6%, then we can move on and do further analysis for the net present value and the internal rate of return. Remember, the net present value is simply the dollar amount that's going to be added to our operating income. The internal rate of return is actually a percent that's telling us how much we are actually earning on our money. The net present value tells us, yes, we're actually getting our minimum required rate of return of 6%. We're exceeding that, but it doesn't give that to us in a percent term, whereas the internal rate of return does. So what other factors should Yummy Candy consider in deciding whether to purchase the machine? Well, what about financing? Are we going to be able to finance the project, and do we have any additional capital to pay for the system? The benefits of the machine from a customer, or when we're thinking about customers, because if we get more customers, we maybe have more variety of products, or maybe faster production time. Maybe we can do special orders. A lot of different things. Another thing we should consider is in that cost of $80,000 for our investment, are there any other hidden startup costs, maybe such as training or any other costs that might not have been incorporated in that? Because when we are calculating the cost of the investment, in this case $80,000, we want to make sure we take into account all costs associated with that. Additional training, additional any working capital if we need it, and so forth. And then let's make sure that the machine is actually going to last 10 years. If we don't do our homework, and let's say the machine breaks down after 3 or 4 years, then are we going to get our investment back? So we want to take a look at a number of things, such as the ability to pay for the investment, to write the check out, any benefits of the machine for our customers so that we can get more customers, more variety of products, and so forth. Ensure that the cost of the machine includes any and all costs related to that machine, any additional cost that may be incurred, and then the machine will actually last for 10 years. So thank you for joining me. My name is Leroy Meadows. Have a good day.